What is equity? What does equity even mean? Yes, we know we look at balance sheet and we say, well, equity plus liability should equal assets. Okay, that we know how to balance a balance sheet, we know how to read a balance sheet, but what is really equity? What is the meaning of equity? What is equity in general, either in business or in real estate? What is equity really from its definition? What's the point of equity? Why does it work for real estate investors? What does it work for business investors? And how can equity help you, or is a metric to measure your true ownership of an asset, whether it's being a business or it being a piece of property? So we know that equity is the percentage of your true ownership in a property or a business, but what we don't know is that what are the implications of it? I want to discuss business first, since a lot of us could be small business owners, a lot of us could work in small businesses, and we want to know, how does equity help us, or what does equity indicate in our balance sheet? One thing that equity is really good for a business is that it measures that, hey, you have these current assets, these long-term assets, and so this is your total asset. But does that mean you own the assets? The assets are yours? The assets are just part of the company? Well, no, because running a business, you always use short-term loans, small business loans, different types of loans. Then what happens is that you may have liabilities on your books. So in your balance sheet, there is a section for current liabilities, which is your credit card debt, short-term debts, usually defined by debts that are year or less, or takes year or less to pay, or their amortization schedule is year or less. And then you have more long-term debts, which are the debts that are more long-term. These are real estate loans. Maybe if you take on like a PPP loan, Paycheck Protection Program loans, long-term SBA loans, which is a good tool for you to get those loans to even start a business. Those are all liabilities that can count against your assets. So the way that your ownership of a business is that, well, how much assets do you have? Cash, accounts receivable, short-term receivables, notes receivable, all the way to more of a long-term assets, which is your equipment, that PPE, property, plant, and equipment. What properties do you have? What equipments do you have? If you're running a restaurant, is the grill, the fridge, the convection oven, the chairs, the tables, everything that you own, they're your assets as well. And those are something that can be turned into cash and then could be used to pay off your liabilities. So the way that equity works, it says that, well, how much cash do you have? How much other assets do you have? Receivables, equipment, property, everything that a business owns as an asset, and what are your liabilities? What's the difference between them? Now, two scenarios where you have a ton of assets and you have little liability, your equity can be higher, meaning that there is a higher ratio of assets to liability. So if you pay off all your liability today using all your assets, you have a ton of assets left. For example, let's say you have $1 million in assets and $100,000 in liability. Imagine in a hypothetical world, you liquidate all that $1 million in assets, where you're still left off with $900,000 worth of assets. So that is your equity. It could be either class of assets that you have after you paid off your loan. Again, for small business owners who are not finance experts, this is a good thought process. Obviously, if we're in accounting and finance, there are different definitions, different ratios, different ways that we look at this. So think about it from a small business owner perspective, not so much as a CPA's perspective, to know what exactly equity mean for you. Now, if you want to apply for additional small business loans, that equity is a part of the evaluation. They evaluate your asset levels, they evaluate your liabilities, they evaluate different ratios. For example, I will talk about it here, but one of them is shareholder equity, or owner equity, or owner's capital, which is how much equity does the owner have in this business. If you have a very low equity, or even unfortunately sometimes no equity, means that, well, you are over leveraged, you're under a ton of liabilities that your assets are either barely or not even able to fulfill. Another indication of that is that if your business is in this sort of trouble, there's no or very low equity, are you ready to take on additional debt? Well, the answer is no. You want to decrease your liability, increase your assets, so this way you have some equity to go ask for additional funding. So now on to the real estate. When we discuss equity, whether it's your primary place of residence or a multifamily property or a commercial property, or we're discussing more of a diversified portfolio of hundreds of different units, equity is still the same principle. Equity essentially means how much asset do you have, which is easier in real estate, because if we only invest in units. And the liabilities are essentially mortgages or private lenders or hard money lenders or all the other lenders that you owe money to. And again, you can evaluate that throughout your house, apartment, this fourplex that you own, this commercial shopping mall that you own, or this 200 units that you own. How much assets do you have? How much liabilities you have? And what's your equity? Equity is good because it shows you what's the percentage of your true ownership of those units, because you don't necessarily own all of them from a finance standpoint, because it means that you have to fulfill your liabilities to fully own those properties. And one of the long-term hold and rent strategies is that I'm going to buy a property on leverage, meaning I'll borrow to be able to buy it, to be able to make money, and then I'm going to just keep waiting, keep collecting rents, keep paying my mortgage. Hopefully the market keeps going up and I build equity, and at some point I'll pay off my mortgage. This is more of a 15, 20, 30 year plan that I have. I get to pay off my mortgage. Suddenly, if I have 100% equity, this way you sort of become very immune to market uncertainties. Market goes up, market goes down. Now you don't have a level of liability that you have to compare your price to. Suddenly your equity is not a function of your market pricing. But also that's important for you to buy the properties at the right time. There is a saying with a lot of old school investors who are actually successful, and investors who actually succeeded in real estate, and they say you make your money at buy, not at sell. Why? Because the reason is, if you buy a property at the height of the market, at the highest point of the market, well, you're buying a property at a very high point. And if you pay your mortgage, which with the mortgage amortization schedule, whether it's 15 or 30 years, you end up paying a lot of interest first, then building equity. So building equity is kind of a slower curve. So if you take on that strategy and suddenly prices come down, market cools off, or especially if you bought a house or if you're buying a house and we see market cooling off a little bit, the rate that you may lose equity might supersede the rate that you're adding equity. The rate that you're losing equity essentially surpasses the rate that you're building equity. So that couldn't be a good news. Obviously that's not the same for everything, is that markets can go down, go up, there's a lot of uncertainties, but as you build more equity, that becomes less of a factor. But it's just important to understand that you want to buy a property at a price that works for you at that time. If you do that, it's going to be great. If the pricing at the buy works for you, you have a good plan to build equity, you have a good plan to get on a positive cash flow, you have a good plan to get a good annualized return from it, and from that you can actually rely on your equity for other things. For example, you can use equity to actually get financing against it. We know about a home equity line of credit or home equity loans. These are options available that use your existing equity on your property as a collateral or as an asset that backs that loan that they're going to give you. And then you can take that money, it's cash, you can use it as a down payment for another income producing property. And then this is a very smart way of using leverage to use the equity you build from one property to go purchase the other. This is a good idea if you have an idea of running your real estate as a business, long-term hold, having it get paid off down in 15-20 years or even less if you're more disciplined, and use the equity from your existing properties to find financing to invest in additional properties. That's a good idea. That's an idea that you can manage your debt. Hopefully the loan to value ratios per property stays consistent, 80 to 90% or so on. And again, as you build your portfolio, as you build more properties, more asset, higher equity per asset, you can actually lower the loan to value ratio for the new properties you're buying. We know for a starter, you want to, or if you don't have enough capital, you have to start with a higher loan to value ratio, sometimes even 90, 95, 99%. It happens. It's a little dangerous. It's more risky because with the interest that you're being charged, sometimes the amount that you owe can be more than what the property is worth, even if we're in a market that's steadily increasing. So that's something you have to be careful for. But if you're using your assets well, if you understand the financials per asset, you understand that you can mitigate the potential risk that comes with it, you have always an option to use your existing asset equity in your assets to go in and invest in additional property with lower loan to value ratio. You can get to 80%, 75% loan to value ratio sometimes. So now, here's a word of caution. Be careful. This is a long-term process. Again, as much as I love to see people on social media, on TikTok, they come at us with these great stories that, oh, we bought a house, We use the equity from this house next week to go buy another apartment. We use that to go buy another apartment, and then we use the money from all those in a matter of weeks to go buy Empire State. Well, I mean, I doubt that happened, but even beyond that, this is not something that happens overnight. You can still leverage that. You can still leverage the resources that you have, whether it's house hacking, whether it's down payment for a commercial property through a hard money lender. If you have an appetite for higher risk, you can do both. I personally never seen anyone do that. First time investors, folks like myself who want to invest, it's slowly but surely. So be careful. This is a long-term investing. This is investing that you're more involved. The rate of return can be higher, but it'll take some time. So if you buy a property, especially in avenues that everybody's suggesting, which is over leveraging yourself or leveraging yourself to the limit, know that there is going to be equity consideration. So it'll take some time for you to build that equity. It'll take years to build that equity for you to use that equity in a meaningful way. So I hope it helps. It was just a quick video that I had thoughts on equity, how does it work in business, and again, in big business, medium, larger enterprises is different. But I hope that what we discussed on equity, what your understanding of equity is, can be improved, because equity is a great concept for you to understand. Is that as you are acquiring assets, equity is a big part of it. But understand that as you're choosing options that maybe have a higher loan to value ratios, or you buy rental properties, single family home that have a higher than 80-85% loan to value ratio, at this point you are trading off equity with an opportunity to invest in this income producing asset. So know that, and be very skeptical when someone tells you, oh yes, I went to a hard money lender, they gave me a sweetheart deal and I bought this property at a 99% loan to value ratio, and then weeks after I took out a home equity loan from that property and then went ahead and bought a bigger apartment, a 6-unit apartment. Just be aware of that. This is all sensationalism. Just be careful. If you have a higher loan to value ratio, there is a trade-off with equity, so it takes some time for you to build that equity, which is fine. You are doing that. And again, maybe if you use a compilation of both, if you buy a duplex, live in one side, rent the other, it's a good idea to have a low down payment, low capital, low equity option, and then you are building equity relatively faster on your own home. You're living for free. Obviously you have money to save up, and then you're saving up that money. You have some capital now. You may use private options. You might even save up 25%, who knows. You go ahead and invest in your next property, whether it be residential or commercial. So you can always use a compilation of different strategies to achieve your goal. Thank you for watching, everyone. It's been a pleasure. I'll always think of new ways to help you with these complicated finance terms. They can be very complex, but they're very easy at core. I'll hope my best to explain it in a way that everyone understands, not in a perspective of a CPA or a finance specialist or an analyst. So hopefully all of us can know what they are and make better decisions in our investment journeys. Discussed house hacking. If you want to know more about house hacking, watch this video. We went into details about house hacking. What is it? What does it mean? What are the ways to do it? And how can you take advantage of it? If you also want to know more about financial ratios or cap rate, check out my video. It's very simple. There's no intimidation. And this is not for me to look good. This is for you to learn and for you to know exactly what these are before you go in and speak to a realtor or a lender. Because remember, these are brokers. These are sales folks. They're here to sell to you. You need to go into this educated. You need to go into this knowing what you want. So learn about these things. Check out my other videos. And if you have any questions, as always, I'll be more than happy to answer you. But until next time, thank you for watching and keep learning.